Welcome to the December issue edition of AML Voices. I'm your host, John Byrne with AML RightSource. This is on a year in review of financial crime compliance issues, both globally and domestically. With me today are Rick Small. Rick is a board member of RightSource. He's also with Truist Bank. Megan Hodge, who's been newly announced as the new AML officer at US Bank, and Jenny Jonas, who is the Senior Vice President of FCA at AML RightSource. As always, you have the opportunity to ask us questions in the Q&A box, and if we can get to those, we certainly will do that. This is a 60-minute conversation, so with about 5 to 10 minutes, we may slow it down there to see if there are questions, but of course you can ask questions throughout the hour. So again, I appreciate everybody taking the time to join us today. We have a whole host of topics that we talked about in our prep call. And so I want to start with this, however. I want to ask each of you for like 2 minutes or so, give or take, what was the biggest surprise for you in financial crime compliance in 2025? The biggest surprise, whether it be a challenge or what have you. What was the biggest surprise? Rick, I'll start with you.
Thanks, John. Good morning and good afternoon for everyone. So for me, the recent FAQs, frequently asked questions on suspicious activity reporting, were actually the biggest surprise for me. Something that, as you know, John, I've been advocating for God knows how long, that the stuff that's in the FAQs actually were not requirements, and that's what the FAQs came out and said. So that was pleasantly surprising for me. I would say the other, I guess not as potentially surprising, but a bit of a challenge is the administration change on we'll call it debanking. I mean, debanking was not really a term of art that I'm aware of. It now is, and it's in executive orders. It will soon be in legislation, I would think. At least that's the rumor. So that to me has been, as I said, more of a challenge on how to manage that, because 4 years ago, things that we're now talking about that are of concern were not of concern in the same way. So those would be my biggest. Debanking a challenge, FAQs a pleasant surprise, because I do think it's going to be a game changer. The last thing, and I know others will talk about this for me, is that I would tell you at the beginning of 2025, I was not a huge advocate of artificial intelligence, but it has really blossomed, in my opinion, in 2025. And I do think that it as well is going to be somewhat of a game changer if we use it correctly.
Well, thanks, Rick. And we will talk about some of those topics that you raised. Jenny, for you, what was the biggest surprise?
I think the biggest surprise for me, John, to steal some of Rick's content there in his response, was the FAQs, and specifically for me, I really thought the notion of a financial institution not needing to document the decision not to file a SAR, was probably the real outlier for me in 2025. I don't know whether I'm old-fashioned or this could be controversial in nature, but even when I was in industry, I was a real advocate for, document. If you didn't do it, or if you didn't document it, it wasn't done. And certainly it's hard to remember things that were thought through and decided 1 week ago, let alone, up to a year ago, when an examiner comes in to take a look at your program. So I've also seen plenty of enforcement actions over the years where examiners have come in, they've seen activity that they've considered suspicious and have not seen a good rationale for why the institution did not file a SAR in that case. And so for those reasons, the notion of steering away from documenting that decision to not file, for me, was a bit of a shock. But maybe I just need to speak to legal counsel and I'll get course corrected. But yeah, that was the biggest shock for me this year, I think.
And so, Megan, we announced your new role that starts in a couple of weeks, but obviously for a number of years you've been at Ally Bank, which is an online bank. So different, sometimes different challenges, not always a parallel with, I won't say traditional bank, but a retail operation where you walk into buildings, all that sort of thing. For you, though, what was the biggest surprise? And again, I think right after you finish, well, let's dive back into the FAQs because I think let's see if there's additional comments. But for you, Megan, with all the work you've done, you've been at a number of institutions as well. What in 2025, what jumped out at you?
I guess I'm still surprised that we didn't get any kind of AML reform regulation itself this year, because I think kind of as we were closing out 2024, it just felt like it was so imminent, like it was just almost there. We got some proposals and whatnot. So I was a little surprised that literally didn't move anywhere to the outward public this year. Hopefully the regulators are still hard at work behind the scenes. I would definitely say I'm surprised and a little disappointed at how what has historically been viewed as prudent risk management in terms of making client decisions, which every bank I know takes very, very seriously, and tries very hard to manage those risks in a fair and prudent way, is being taken as a political statement of some kind, and sort of being positioned as debanking, which has caused harm to individuals and institutions. And so that part I think has been just a very disappointing surprise, because everybody I know who is in this industry has thought very, very carefully about policies that they've put in place and has worked really hard to try to keep the harm to the customer and the institution at the forefront. So that's been a disappointing surprise, seeing that turned into a completely different discussion.
And you, me, and Rick have been working for years trying to help humanitarian and charity groups with what we call the de-risking issue. And so maybe we'll come back to that. But let's go back to the FAQs, Rick. Do you want to briefly describe them? Jenny gave you some more definition around them, and then the three of you should sort of talk about, from a practical standpoint, what are you anticipating? And I know we don't know yet because there hasn't been exams since that time, but give us maybe the pros and cons. You've just said you're pretty complimentary that they did this because, as you and I, Megan and others, and have always said, these were never requirements to begin with. So that part was positive. But what are some of the compliance practicalities of this, if you don't mind?
Yeah, no, absolutely. So just as a reminder, there were three call outs. One is on currency transaction reporting and the reporting of structured transactions and what structuring actually is. The second was around what we refer to as continuing activity reviews. So the notion that once you identify and report suspicious activity, you have an obligation to continually review that and report if the activity continues. And the third, as Jenny mentioned, was around the documentation for a decision not to file a suspicious activity report. So kind of working backwards, forwards is that, over the years, as I'm sure we have all been managing through, there was an expectation, not a requirement, that we fully document our decisions not to file suspicious activity reports. And that has led to, I like to sarcastically joke that, that's led to writing novels around why we don't file as opposed to why we file. In some instances, our documentation around non-filing is more significant, or had been more significant than our actual filings. So now we have an FAQ that says, and by the way, we should note that everybody kind of calls these FinCEN FAQs, but all of the supervisory agencies joined in. So Federal Reserve, Office of the Comptroller of Currency, OCC, and Federal Deposit Insurance Corporation, and National Credit Union Administration, they all jumped in and joined in on these FAQs. So we have an FAQ now that says you actually don't have to document decisions not to file. Now, I will tell you that, in my opinion, that would be a huge mistake. What I do see is the ability to document a lot less. So, for example, simple example would be we have something that alerted. We look at the transaction history. We look at what we know about our customer, and we say, this is normal transactions for our customer. To me, that could be the extent of the documentation. Whereas before, we would have written 10 pages around, well, we looked at these 10 transactions. We have transactional history that looks like this. We did Google searches. We sent out a private detective, and we're documenting why we're not going to file. So I think that's a huge opportunity for financial institutions to manage through that. I would caution that whatever you all decide to do needs to be fully documented. So we shouldn't leave anything to chance. We should be able to say, look, we're going to document in this manner our decision not to file. So that's number one. Number two, again, working backwards, is continuing activity reviews. So I've been kind of yelling and screaming for years that there's no requirement to do this. It became an expectation. It was actually written into those, John, you and Megan, I think you'll remember when we used to see those SAR activity reviews.
The very first one, because that was a question responding to my question.
Right.
The very first one.
Thanks, John.
Exactly.
Yes.
Exactly.
But in my defense, it was rule of thumb was the answer, not an expectation.
Yeah.
So,
But so we got there, right? We got to where clearly there was, and I would say more of an expectation, because we all get examined for that when we have supervisory examinations. So this says there's no requirement to do that. I will tell you that my position on this, and others may have different views, is I think that's great. There may be instances where we want to do a continuing activity review. I will never call it that again, but there may be instances. So for example, let's just use an example of an escalation as opposed to our automated transaction monitoring. So we got a 314B request, and when we looked into it, we saw some activity that we didn't like. We may want to watch that over and over again to see if it's there, if it continues. We get a grand jury subpoena, and we use that as sort of an alert to determine whether or not we have activity we need to be concerned about. We may want to watch that several times, but I'm not going to call it a continuing activity review. And then for automated transaction monitoring, I'm done. So my view is there is no continuing activity review. If it's activity that pops up again from our automated monitoring and we think it's sufficient to file again, we'll file again. But it takes out an entire very burdensome process, in my opinion, of having to put them in a queue, make sure you get them in a timely manner. You know, is it 90 days, 120 days, whatever you are all doing. Now, I will say, and again, let others chime in on this in a moment, if you're going to do continuing activity reviews, that's the fourth FAQ. It's actually number 3, but it says, here are the guidelines you should follow in terms of your timing. So there's a structure around it for a non-requirement. So again, that's why I don't ever want to talk about continuing activity reviews again. And then the big one for me is the structuring on the currency transaction reports. And it's been very challenging over the years to define, is that structuring over, so you have 5 transactions over 3 weeks. Do you think that's structuring? I mean, this clearly says you have to follow the CTR rule, which is within 24 hours or a business day. So again, I think there's an opportunity to redefine how you're looking at structuring, and that may, I think it will, significantly help in terms of management resources, efficiencies, things like that. So I took longer than 2 minutes, so I'll obviously let others chime in.
Yeah, Megan, additional thoughts to what Rick said?
I mean, I think Rick really nailed it. I think we're still going to have to continue to be smart about what do we think we're prepared to defend during the next exam in a couple of years from now. So I definitely don't believe that just because we don't have to document our no SAR decision. I definitely don't think it's a good decision to just not do anything and just say not suspicious and close the file. I do think there's a lot of opportunity in the structuring piece, because I just think that across the industry, there's been inflation of expectation. where everyone thought, well, if you're looking at, 8 to 10, shouldn't you look at 7 to 10? If you're looking at 3 days, shouldn't you look at 5 days, or shouldn't you look at 2 weeks? And so I think it's gotten very, very broad across the board. I feel like that is one that banks really can lean in. I know I'm in, different working groups with partners across the industry, and that seems to be an area that cash-based institutions are really taking a hard look at. I agree with what Rick said from the continuing activity investigations. I think if you've got a solid transaction monitoring system, we can all count on our transaction monitoring system. Having said that, I would really like to take advantage of the relief that I think FinCEN was originally intending, which says that you can hold on to those for 90 days and kind of look at them in a group. And then I think that for the activity that was identified outside of the monitoring piece, I think that's where banks are going to need to be really thoughtful and make sure that they have a good, sound approach as to what they're doing. I know that we've had conversations internally. We're looking at what our historical practices have been. We're looking at dollar amounts involved. We're looking at what the original source was, and just making sure that we can create, a really sound, defensible position as to what we're doing. But also, I really want to make sure we're kind of keeping it contained and we don't find ourselves in the good idea expansion, with saying, well, if you're looking at this thing on a periodic basis, then why not that thing? So I really want to make sure that as we're approaching it, we're kind of going steady enough that we can have a decision that lands.
Jenny, I'm going to switch topics, but first give you a chance and start with you with that. But I'll first give you a chance. Anything else you want to add? Anything that maybe clients are asking you folks when you come in and in terms of your advice and counsel?
Yeah, I mean, look, Rick and Megan gave some really fulsome responses there. I think the only thing that I'd layer on top of what they shared was, for me, these FAQs really had an undertone of, simplification, if you will, of transaction monitoring programs, and as it pertains to defensive SAR filings, I think really set a tone whereby there's now an avenue for us to, as an industry, to really lean into, right? If you don't have a good reason to file, don't. And I think long has been the practice where if we don't feel like we can substantiate strongly enough a reason not to file a SAR, we should file a SAR. So we're in, a better, I guess, stance when the regulators come in to do their exams. So yeah, not too much more to add than Megan and Rick covered off. Just want to acknowledge kind of the theme and the sentiment that the FAQs in totality kind of conveyed to me, at least.
One of the questions that came in, it's kind of relevant to everything we're talking about. Is there a chance that guidance or FAQs could change with another administration? There's always that possibility. So I think you have to just factor that into however you're going to use your resources. I want to jump into cryptocurrency. Obviously, there's been a massive, dramatic change and embracing, if you will, in cryptocurrency within this administration in 2025. Not the same amount in the EU, at least from my perspective, but from a compliance challenge perspective, starting with you, Jenny, what are some of the things? Again, we have clients that are exchangers, and obviously we have bank clients that are engaged with cryptocurrency. But what are some, from a high level, what are some of the compliance challenges for the AML folks regarding crypto, just in general? And I'll obviously ask the other two to weigh in as well.
So, I mean, if I first reflect back on 2025, where crypto is concerned and crypto regulation, obviously we've seen quite a substantial shift. I think when we entered 2025, we were really in a more enforcement-driven environment. Now we're getting more into like a framework first, if you will, stance or kind of environment. I think that is a positive thing, right? I think it's reduced risk in regards to being innovative in this space. It's created greater clarity on what's needed, what needs to be in place when you enter that sort of market. The Genius Act certainly helped clarify a lot of that, and certainly regulators are really supportive now of innovation in this space of institutions offering and issuing crypto. I think that one of the challenges, though, that comes with the introduction of regulation, and I talk about frameworks, and I talk about this very broadly globally, right? Because there's been a lot of movement, not just in the US, in this regard, but internationally too is this won't shock anyone on this webinar, but there's not a lot of alignment, I would say, between, or there's not certainly full alignment between, the frameworks and the requirements that the US introduces versus the EU versus, Singapore. So there are inconsistencies globally, and I think when you are a global crypto issuer, even when you're a global bank looking to get into this space, that creates some challenges. I mean, it's not a challenge that traditional banks haven't faced before, and certainly have been able to navigate it by establishing, global standards and then having certainly exceptions at a more local level to recognize the nuances. But I think because it's such an evolving space, it's going to be really important for organizations or for institutions and crypto issuers to stay on top of the changes and constantly be looking at their programs globally, locally, to make sure they're in lockstep with what regulators are requiring, but also what the regulations require, but also what the regulators are expecting. So having a good framework for doing that, process for doing that, but also having local industry experts, I think is going to be really important, because that cross-jurisdiction regulatory variation, I think, is a big challenge in this space as it continues to evolve.
Rick and Megan, I know you participate in various roundtables with your peers. Your views and your peers' views, what are some of the things that people are raising regarding crypto, again, from a compliance perspective? Rick, I'll start with you.
Yeah, so we haven't been there yet, but we are thinking about it. I would say from my experience, haven't had to deal with it a lot yet. So, have never been a big fan of banking exchanges without the ability to significantly resource the controls that would be required to do that. But I do think, as banks, and ours may be one that wants to engage in some way in that, we're going to have to think about it differently. So I'm kind of skirting around the edges because I haven't really had to deal with it. I will say that for those that may not have seen it, there was a good article in the New York Times last week about stable coins, which when we talk about crypto, we can talk about the Bitcoins and things like that, but there are also the stable coins, which are tied to a currency and have to have assets backing them. And I think that's where a lot of banks are looking, that they want to use stable coins either as an asset on their own or as a means to move money quickly. And this article is about how money laundering is still happening, significantly happening, at least according to the author, in stablecoins. So that concerns me in terms of how we're going to build out controls to manage that if our institution wants to engage in that. And so I don't have an answer,
right?
But it certainly is something that I'm concerned about.
Megan, again, yourself and then your peers, what are they saying?
Yeah, and I'll just sort of, start from the standpoint of, most of us that are at financial institutions aren't necessarily banking exchanges themselves. But we do see our customers engaged with cryptocurrency because we see customers moving money back and forth to crypto exchanges. And, Ally is a digital bank. And so as a result, we have an, I think, unearned, but yet there it is, reputation for being very crypto friendly, probably because we just haven't put outright prohibitions in the way that some institutions have. And so we have, used the fact that money is going to or from a cryptocurrency as just simply a data point, right? We are doing like everything. We're constantly monitoring our customers' activity, and we're looking for activity that looks like it could be illicit or doesn't make any sense. And so I think it's important to sort of try to sort out the good from the bad. Not all money going to or from a cryptocurrency exchange is bad. In fact, stats would tell you that most of it is not bad. I think I was reading something, TRM Labs reported that crypto exchange activity or cryptocurrency activity has a rate of being illicit at 0.4%, but then fiat, activity, US dollar activity in fiat is, I think 0.1. So it's still relatively more risky, but you certainly can't say that just because money is moving to or from an exchange, that means that your customer is doing something illicits. But we, have created frameworks and guidelines and training for staff members within our investigations group to try to help them contextualize what would be considered normal for a customer and what would not be. A person taking their hard-earned paycheck and investing in crypto makes all the sense in the world, nothing illicit going on. If I'm collecting money from each one of you all and you're selling me and it says crypto, and then I'm making one payment placement over with a crypto exchange, then I'm probably an unlicensed MSB. And that's going to be a problem. Or if you're seeing, lots of money movement from unrelated parties and it's going to cryptocurrency, it looks like maybe it's fraud coming in and moving over to cryptocurrency, that would be a problem. So I think though, as it just becomes more and more commonplace, a lot of people continue to move money into crypto for whatever reason. And I think it just becomes something that as a bank, we have to deal with. We've got to figure out how to identify it, how to sort out what's good versus what is a problem, and make sure that we are not, falling on the wrong side and being criticized for being overly restrictive. But on the other hand, like if you're seeing illicit activity, you got to file a SAR on that for sure.
And it seems to me that the EU is clearly more skeptical about the value proposition of crypto than we are here. So it's going to be interesting to watch the parallels in terms of compliance and responses going forward. Jenny, one of the things you talked about in our prep call, you wanted to make sure we covered banking as a service and some of the issues in that space. Do you want to talk a bit about that and some of the challenges that you've seen with our clients and just in general your thoughts regarding that?
I'd love to kick off this conversation or discussion around this topic. We are seeing quite a few institutions receiving enforcement actions where they've been engaging with fintechs through banking as a service relationship. I think a lot of what regulators are picking up on are themes that have appeared like in other areas or in other relationships, right? It's like not new themes. It's like inadequate oversight of those partners, the monitoring, integration, accountability, and just due diligence around those parties. So it's definitely an area we're keeping an eye on as we move into 2026, and especially as we partner with a few clients who are actually observing or experiencing enforcement action in this area. And a lot of the changes that they're looking to institute will come as no surprise. It's really, building on their existing AML program and beefing up the controls over these types of relationships, which for one reason or another they had not done before entering these types of relationships. So I think we're hearing this be a focus for a whole range of US regulators, FinCEN, OCC, and the like. So I don't expect the focus on this to go away in 2026.
Thoughts, Megan, on banking as a service?
No, I think you're right, Jenny. Some of the things that the regulators have signaled are presumably continuing to work their way through the system. So I think all of the parts that you're mentioning are spot on. I think that to the extent that banks are working with fintechs, it just was really important to dig into how does the product work, who's on point for transaction monitoring, what's your contract say, do they have a license to move money, are they considered an MSB? There are a lot of nuances that I think, at least from where I've sat, they aren't necessarily at the forefront when the business partners are coming up with the good revenue generating ideas. They think it's going to be a quick and easy way to bring more loans in, assets on the books, whatever it happens to be. And as it turns out, it's really quite complex when you get behind the scenes, and there are a lot of traps that you can fall into from an AML standpoint.
Yeah, I would really love to see, John, sorry to step back in a second to this conversation, but I would really love to see in 2026 some sort of guidance come out to the industry on this and the risks that the regulators have seen as they've gone around and done their exams. So I think there's a lot to share that would be of benefit to the broader industry. So hopefully we'll see something like that in 2026.
Rick, anything to add?
No, I think you got covered.
All right, so it's the holiday season, and all the banking agencies and whatever consumer agencies are still around, issue warnings regarding scams, whether they be relationship scams, elder abuse, all sorts of things. Fraud continues to be obviously a major challenge for us, Rick. And if we were doing this 10 years ago, we probably wouldn't even be covering fraud in an AML related conference, but or conversation. But obviously, that's been part and parcel for many years. You were, with a lot of your colleagues, very clear during the pandemic. Soon as they started issuing all these checks, there's going to be massive fraud. And of course, you were proven correct. What are some of the, not even challenges, what are some of the recommendations all of you make to your peers regarding scam prevention? Part of it's outreach and explaining to customers what they should look out for. But do you get on more of a high alert during like December, or it's just an all year sort of thing, just in terms of fraud, again, elder abuse and all those issues? What do you think?
Yeah, I mean, I think it's an all year thing right now. I would say that the fraud remains consistent. Check fraud is pretty significant still. Now, just by the numbers, because you have a lot more purchasing over the holiday season, you're going to see credit card, debit card fraud move up. But what we see is that the bad actors are getting much better at able to get the information that they need to create synthetic accounts, to steal identities, and to get access. So I've just seen yesterday and today several more cases come up where unsuspecting customers are giving away their credentials. So I think we've gotten much better at identifying the fraud and catching it early, and hopefully by doing so are helping our customers save a little bit of money. But I would say that we're still not, as an industry, and I don't know that we'll get there, and I don't know how much is our responsibility either. But I'm not sure that we are yet in a place where we can stop it before it happens, because a lot of it it's based on the customer doing something unfortunately stupid prior to us seeing it. So over as another example, over the last couple of months, seeing a big uptick in business email compromise. So one could argue that as the bank that has the account for what turns out to be the fraudster, it's our responsibility to know that. But we don't know that if the account gets opened and is maintained in the way that we expect it. So it gets through all of the identification, verification checks, and there's not a lot of activity in the account that would suggest it's suspicious. And then you have a large money movement come in. We're getting much better at stopping those and going and asking questions, but to me, it's incredible how often it happens. Somebody gets an email the night before they're closing on a house, and it gives them new wire instructions. How do you not pick up the phone and call and verify that you've got the right instructions? And I know we're all doing this. So whether you're on Zelle, for the banks that have Zelle, or whether it's Wire ACH, we have all kinds of pop-ups now. Have you verified? Are you sure you want to send the money where you're sending it? But yet it still happens. So all that to say, John, is I do think fraud is up. It is trend setting. It's going to continue. And by the way, I mean, the fraudsters take some of their profit and pour it back into getting more sophisticated and creating the fraud. So it's a great business for them.
So Megan,
Yeah.
again, given Ally Bank, obviously, still fraud, but the online version, so cybersecurity becomes essential here. What other things? And let me ask it this way. I'm sure you do the same thing with your client base, send out messaging about being careful and all that sort of stuff. I'm assuming you're still seeing a massive rise in fraud, even with Ally, right?
Yeah, absolutely. I think it's across the board. And I think that the social engineering part has been, a real accelerant for some of the fraud, because people are contacting the customers and, pretending to be other people, at times pretending to be your institution. And so, and they play on all of the things that you expect, fear, urgency, something bad is going to happen. And so just a small tip is I think that if ever anybody gets a call from someone claiming to be a bank, I would just hang up right then. I would take my debit or credit card out of my wallet and I would call the number back on the wallet, because I think that it's difficult when the customer is participating unwillingly, because then they're really helping the bad guys bypass the controls that really would be excellent if you didn't have the bad guy, getting the answers to, the PIN that you texted out or the extra multi-factor authentication. But yeah, I think every bank, John, is just
Sure.
seeing this continue to go up and up and up.
Jenny, when you're working with your clients, when you're putting something together for them proactively, what are some of the things that you recommend that they put in as a fraud prevention tool, besides the obvious ones that all banks are probably doing anyway?
Yeah, I think one of the hotter topics, I think, in the control space over the last few years has really been the biometric tracking or monitoring, being able to pick up on signals like as well. At least I still am impressed by this, as advanced as when what hand the user who is making that transaction through your institution holding their phone, through how quickly they navigate your website. I think we've got to, and certainly the industry's been focused on going beyond, traditional fraud controls for some time now. I think as deep fakes continue to be problematic, or just as AI usage expands and deep fakes continue to be problematic across the industry and just get utilized to a greater and more sophisticated extent by bad actors, we've got to start to look at utilizing technology to counteract that and detect when either through a video call, which I know a lot of institutions are looking at or have implemented to try and overcome the notion of or to identify the interaction with a deep fake, or call monitoring. We've got to use technology to fight technology, because I only think those problems, deep fakes and the use of AI, generally is just going to become more pervasive to exact these frauds. So definitely looking at more sophisticated fraud controls. But honestly, I also think that even just going back to basics and even going right back to your risk assessment, and periodically going in, refreshing that to really identify flaws or gaps in your program is really important. As as archaic or mundane as it sounds, doing that analysis periodically is really where you get to confirm that your program's robust enough, or in fact identify, as I said, where you've got gaps and swiftly make moves to close them.
Rick, we want to go back to de-risking, debanking. The question came in that sort of relates to what we talked about with SARS. Somebody asked the question, basic question, not in a pejorative way, but important one you deal with all the time. If a customer continues to exhibit suspicious behavior in their account, when is it appropriate to offboard or eliminate or exit that relationship, and how should we document it, especially if multiple SARs have been filed on the customer? So respond to that, but then let's talk a bit about the whole issue of debanking and the recent report study, if you will, about what the OCC claims are examples of improper debanking.
Yeah, so it might be worth just starting on the banking for a moment, because in today's world, exiting a relationship or not engaging in a relationship for political purposes, for religious purposes, are the I'd say the big call outs on the debanking. So, and I don't think that we in the financial crime space have done that, with the exception, which I'll mention in a moment, for the most part. So, get back to the actual question. It's an institution by institution determination.
Right.
One of the things that I am focused on is making sure that we actually document our strategy, if you will, for exits, So I've never been comfortable with 3 SARS and you're out, and because in one instance the activity might be so egregious that you want them out. In other instances, and this is where there's I think a good overlap of what we used to do and the FAQs, because we would have a customer that continually did transactions that one could make the argument were done to avoid a currency transaction reporting filing by the bank, but you didn't really think it was suspicious. So the restaurant owner, example I like to use, who never likes to keep over a certain amount of cash in the restaurant and does enough business that every other day they're coming in with just under 10,000.
Mm-hmm.
One might argue that looks like structuring, and I'm sure a lot of us would have filed on that in the past to protect ourselves. So if we want to call it defensive filing, whatever. In today's environment, I don't think we need to do that, but that comes back to, if you really don't think there's structuring, then why are you going to exit? And so there just needs to be a lot of thought process around why. And when I say document it, I'm not suggesting that you have to document, we will exit if this happens. I think it needs to be more thoughtful. But back to the question, if you have activity that you are concerned about, you think it's suspicious, then I think you should exit. And if that is a one-off, or if that's 3 times for you to come to that conclusion, so be it. I mean, the one-offs in today's environment, you might say, you know what, I think I'm going to file just because it looks suspicious. If it doesn't happen again, then you might be fine. Whereas there's the one-off where you clearly know that you never want this customer coming close to the bank again. So I think that's a long answer around. I actually think we'll have a little bit more latitude to make those calls today, especially given the FAQs and what we're seeing about debanking.
Well, let me ask you this, though, and you had to deal with this. You have to deal with this at Truist. There's a couple of states that you guys are in, which passed state laws that said that, and I'm paraphrasing here, that someone can make a claim that you exited a relationship for, as you said, for religious, political, or whatever reason. And I assume to date, no one has made those claims. But how does that impact? And very similarly, what the OCC has said regarding what they consider to be a political decisioning about not banking people that sell assault weapons and private ATM owners and all that sort of thing. What do you do as a banker? Forget about the politics. How do you craft a policy to ensure, again, you document, 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 but what other recommendations do you have and do your peers have to respond to as a brand new world regarding exiting relationships?
Right. So thanks for bringing that up, because it needs to be part of the conversation. Florida and Tennessee in particular, they have what are called fair access laws. And that's, I think there's at the federal level, proposal, something like that. John, you may know or remember better than I do. But the notion is that everybody gets to either have an account or not be exited, unless there are legitimate reasons for doing so. And what they talk about is quantitative versus qualitative. And qualitative gets you into reputational risk, which gets you to religious and political. And so for us, for example, we used to have reputational risk in our AML policy that we would consider a factor in our risk discussions, the reputational risk. And that's one of the things that the OCC called out in the preliminary report, that banks had that in their procedures. We're not doing that anymore as a component for a financial crimes process. Mm-hmm. So if we're exiting because we've identified suspicious activity. And while Florida's the state that's more focused on this, in my opinion, while there's not a specific call out that filing suspicious activity reports or something like that is an exclusion from the fair access, there was guidance from one of the state agencies that oversees banks in the state that said that this fair access doesn't trump our obligations under the Bank Secrecy Act. So I do think there are ways to manage it, and that's the way we're managing it. We are looking at the information that we have. So we have a customer. The customer has engaged in activity that is suspicious, and we've addressed that. We're going to exit, and we're not going to worry about the fair access. And I would argue, and I don't know if this happened, but 3-4 years ago, we may have had a client or a customer that was engaged in the sale of automatic weapons. And a bank would say, do we really want to bank that? Do we want, and may make it could be reputational, could be political decision, could be environmental decision that we don't want to provide the ability for people to buy those weapons. That can't happen today under the fair access, and it's not going to happen based on the debanking either. So it's a change in times.
But it could happen based on that business not being run well, but that's a whole different analysis.
Well,
right?
right, but that business not being run well would not be so. There would be no reason to be looking at, for example, an AML program because they don't have requirements. There would be, if they're not borrowing, there would be no reason to look at from a credit perspective. If they just have a deposit relationship, in my example, whether we like it or not, there would be no reason to exclude them from banking.
Right. Jenny, what are your clients saying, if anything, since that report was issued? Targeting is the wrong word, but identifying a few large institutions and saying that they had, in fact, exited relationships for those reasons that Rick mentioned. Any of the either clients or people that you've talked to, are they doing what Rick's doing, taking reputation out of the policy, making adjustments? What are some of the things you're seeing?
Yeah, I mean, there's definitely cleanup happening pretty broadly across the industry, across our clients, when it comes to the documented programs, and their policies more specifically. When I talk to clients about it and their concerns about how much of a restriction this is going to put on them in terms of being able to exit or not bank certain types of customers, I've always tried to, for them, bring it back to what they've got documented in terms of their bank purpose, the markets they serve. Every institution is crafted differently, right? Different sizes, different resources available to them, not just purely from a headcount perspective, but from a funds perspective. And so the programs and the extent of the controls that they can set up really vary. And I still think there's a valid rationale, a valid logic to support a case where these riskier sets of potential clients, foreign correspondent banks mentioning just one, a smaller institution with less resources available to them is not going to be able to support the management of that risk. And so I think tying or bringing back, the purpose of your business, the risk appetite, if you will, and the resources that you have available to you to develop that and maintain that AML program and the controls, those are really important supporting arguments for who you then go on to bank or not bank. So really trying to pull clients back and pull conversation back to what you have documented today and how does it substantiate exits or even not banking a particular group of customers.
This is all going to be fascinating once the examiners start going to your institutions. Rick mentioned it up front, and I'll start with Megan. We got a question on this as well. Talk a little bit more about artificial intelligence and how it's currently being used, if you feel that it is, in terms of working with analysts and that sort of thing, or how it can be used. What are some of the things? What are some of the challenges? Obviously, we have all done webinars just on AI, but talk a bit about that from a financial crime compliance prevention detection perspective. Megan, I'll start with you.
Yeah, and I'm gonna talk a little bit more in the theoretical because we're taking a slow and cautious stance towards things within my current institution. But obviously, there's a lot of activity that analysts do that is probably not their favorite activity. I don't know of an analyst who gets finished with an investigation is like, yes, I can't wait to document that. And I can't wait to make sure I've ticked and tied everything that the procedure said I needed to do. And then I've referenced the specific FinCEN guidance documents reference number in there. So Where I see there being a real benefit to not only making sure that we increase the quality of what we're doing, but then also, take some of that drudgery away from investigators who just want to get onto that next exciting case, is really use the tools to be that double check for the investigator to make sure, like, hey, it looks like your policy says you should have done, you should have looked at 6 months of transactions. I'm only seeing 5 months. Would you like for me to pull in that extra month of activity? That would be amazing. Being able to sort of do that, quality check for the investigators, be able to help write some of that narrative information. And then also be able to take that another step further and help the teams who do the quality checking, because you still need, at this point, some, I think, human assurance that the work that's being done is in fact aligned to your policies and exercises good judgment and all of that. I think it'd be an excellent tool. Again, the people that are working on our quality team, they're some of our best investigators who sort of continued to move up in the ladder. It's not their favorite thing to check, does this field match this field? Does this, number of transactions match up to this number of transactions? Anything that we can do to help increase the quality and be able to take our quality standards and push them across everyone so that we're less human intensive is really good. So I'll just sort of start there as a basic place. I'd love to hear, from Jeannie and Rick about what they're seeing and talking about.
Yeah, Rick, you talked about it that you're, I don't, paraphrasing, more of a fan than you might have been at the beginning. So you do see some value. Talk a bit about that.
Yeah, I think we're seeing a lot of opportunity to think about how to become much more efficient, and not devote resources to areas that really don't help with the mission, whether that mission is protecting our own organizations or in the greater good of what we do. So I do see that as opportunities. FAQs, one place. One thing I forgot to mention at the beginning, John, was that, and I haven't heard a lot of people focusing on this. There were orders from the agencies back in July on CIP, Customer Identification Program, requirements, which, as you remember, requires us to collect a taxpayer identification number, usually Social Security number, from the customer. And this order, pursuant to the CIP requirements, there's a provision in the regulation that allows for an exception to that if the banking agency and FinCEN both sign off on it. And so the agencies each did orders that say, you know what, you don't have to collect that TIN from the customer anymore. You can get it from elsewhere. To me, that's significant. And like I said, I'm not seeing that a lot have jumped on that yet. We've always had that ability on credit cards. That was written into the CIP regulation. I think, John, you and I were big. We mustered a big lobbying effort at the time to at least get that for credit cards, because it was a huge issue to have every credit card application to get it from the customer. But like I said, this to me is another area. So the FAQs, I think if we do it the right way, and this is the time to do it. I think I know, you had the question early on about, does this change in the next administration if there's administration change? Some of this may, but I don't think this stuff will. So I think the FAQ type stuff, I think these orders on not having to collect TINs directly from the customers, they are going to be very useful to us. We need to act on those now, be aggressive, but document and establish what you want to do to change that. I think that will help, because the downside of that, and you made the point, I don't know when this trickles down to examiners, which is always our challenge. So we have the agencies saying we're making these changes. I continually hear from colleagues that the examiners either aren't adopting or are unaware. And I think that's just a time frame where we need to make sure that they understand what we're doing.
Anything more, Jenny, on AI? Like I said, I know we could do a couple hours, but just in general, what are you seeing both internally with us, but also with your clients?
I think the most common way that I'm hearing of AI get utilized is there's two ways. One, I think going back to Megan's point earlier about being that check and balance, against something that's been prepared, be it a narrative, be it a due diligence package, right? To help lift the quality control burden. But the other way I've heard it, institutions starting to dabble, if you will, in the use of AI more extensively, is when it comes to transaction monitoring, SAR preparation. So utilizing all of the case information that's been collected by the investigator, turning that using AI into the SAR narrative, but also the populating the SAR form. We're hearing a lot of institutions, because through our conversations with a lot of our clients, exploring how else they could use AI. I think the next probably one or use case down on the ladder that I've heard of most recently from our clients has been with the alert portion of the transaction monitoring process, right? Reviewing those analysis, the transactions, and at least coming up with a recommendation that someone then is checking. It's not certainly being utilized in isolation without the checks and balances, and then obviously being utilized to formulate KYC or if you will, periodic review, event-driven review analyses. So there's definitely a lot of conversation going on about it in the industry. Definitely an uptick as we've gone or come into late 2025 in terms of how frequently we're talking to clients about it. So I think it's going to be really interesting to see again how, as we turn into 2026 and exams start to be performed over the use or over programs that are using AI, what the regulators really are thinking about the quality of the outcomes now that AI has been introduced, if they're concerned at all.
One thing I'll just add on to that, I was speaking to somebody in another institution last week, and she was saying that they had been doing some test and learn with narrative generation, and she said it's really great stuff. It's accurate, it's very good. It would definitely save us some time. Our problem is we don't have a secured environment that is segregated from the other parts of where the AI magic happens within our institution. And so we don't have a way to keep SAR confidentiality information as tightly protected as we need to. And so at that point, that is their biggest barrier. That is the concern that the regulators are stressing as well. So I just thought that was an interesting one that, again, we just need to all be mindful of, that we got to still watch our SAR information confidentiality, and absence of a SAR is still SAR knowledge.
We have just a couple of minutes left. I want to go through.
Hey, John, I'm sorry to interrupt you. I should.
Let me just set the premise.
Okay.
I'm going to have each of you give me one prediction for 2026 in financial crime compliance. But go ahead, Rick. Respond to Megan.
No, I was just gonna tie back to my ramblings on the FAQs and the orders, because I think those are areas where, and that's where I was sort of going with the AI. I mean, that is perfect opportunity, and that's what I was talking about at the beginning, and I forgot to connect that. So my apologies for that. I got more engrossed in the FAQs than the AI part of it. So for my one thing, I actually think it is AI. I mean, I think this is the time and the place, and this is the opportunity. And more broadly, this is the opportunity for institutions to make change, make smart change, document change, but take advantage of the ability to make those changes now. I don't know when this is going to happen again, like it appears to be happening now.
Megan, what do you think?
I think Rick absolutely nailed it. IRSCI has been doing some really great work with expanding their outreach to banks and being more communicative about cases that are really valuable. So I'm really looking forward to seeing how banks are able to leverage that return intelligence to sort of go after more stuff. And I would really love to see other federal agencies go down that path as well.
Great point. Jenny.
I am really keeping a keen eye on, this trend, this deregulation trend as we go into 2026, not just because I'm a consultant and we make money off of, compliance and the need to be in compliance. But I just think it's a really interesting trend that we've seen this year. It's going to be interesting for me in 2026 to see how far it goes. And then, by the time we get round to the next administration, how far it comes back. So I know in conversations that I've had with clients of late, there is a bit of hesitation, to make, big or even to fully anticipate big changes coming in, and even when they do, how far they should move away from this traditional stance with these compliance programs. But yes, I think how the pendulum swings over the next 12 months and beyond is going to be a really interesting thing to sit and watch.
And I will echo that to a degree and say that I think what we're going to start to see in the next couple of years is, while we all wanted to see improvements in the AML infrastructure, I'm not sure we wanted to see everything that's gone on or could go on. And I think there's going to be it's not a backlash. There's definitely going to be increased fraud, increased laundering situations, sanctions evasion. It's going to be fascinating to watch. So I assume most banks will sort of slowly make decisions on resources. Like you said, Jenny, they're not going to overnight say, well, we're going to do away with this or that. But I think it's something to be very, very careful about, because this year has been chaotic to say the least. Not so much in Europe, but here. So uh, I want to thank Rick, Megan, and Jenny, of course, for participating today, and those of you that stayed with us and sent us questions. We appreciate, and comments, a lot of comments in there as well. So we appreciate your engagement. In January, our webinar will be on, because it's Anti-Human Trafficking Month, will be on an area related to the continued scourge of human trafficking. So we will be posting that shortly. Also want to remind everybody that we do AML Conversations podcasts, and they come out every couple of weeks or so, depending on who we're interviewing. And This Week in AML is posted every Friday. So thank you all so much. Appreciate the time. Happy holidays, everybody, and please stay safe.
Bye, John.